So, good afternoon, and good morning, good evening, good night to those who follow us live online. My name is Gábor Hanak. I'm from Hungary. I'm the chair of the IAA's Climate Risk Task Force and also a past president of the IAA. So this session will be about giving you information about the works of the Climate Risk Task Force, CRTF, sometimes abbreviated CRTF, of the IAA. And I will introduce very shortly the speakers of this session. There will be not much time to ask questions in between each presentation, but at the end of all presentations, there will be some time to ask questions and answer those. So Barbara D'Ambroggi-Ola at the far side, Dale Hall, Darren Fleming, Evelyn Yong, Rade Musulin, and Sharanjit Paddam closest to me. So we thought about how to present the work of the Climate Risk Task Force. And we decided to give a glimpse of each paper which we produced. There are 7 papers that have been produced and published over 3 years. The whole work of the Climate Risk Task Force started in 2020 with approval of the Statement of Intent by the IA Council. And these were the objectives of the Statement of Intent: promote actuarial approaches in climate-related issues, assist stakeholders with advice and making an impact on those stakeholders on climate-related issues, and provide actuarial nature education to actuaries out there, but in reality, not just actuaries, but other professionals as well. And our task includes monitoring emerging information in that space. Also, we need to be relevant to all stakeholders, so a balance of relevance to each of our stakeholders, like IA member associations and international key stakeholders, international organizations, individual actuaries, and so on. And adding value to the IA members, and not just collecting information, but adding some value in an actuarial context. So we have produced so far 7 papers, as I mentioned. These are first a foundational paper, and Rade will be talking about that. Then 2 papers on climate-related scenarios, one basic and then more advanced on insurance and other financial institutions. And Evelyn will be talking about that. Then a paper on assets and valuing asset portfolios in relation to climate-related risks. And the 5th paper, Dale will be talking about that. And then the 5th paper was about the disclosures and risk management. Darren, you will be talking about that. The 6th paper, which was just released a few weeks ago, early May, is the 6th paper on climate change adaptation gap, and Barbara will be talking about that. And we have managed to secure a joint paper with the IPCC Working Group 1. IPCC stands for Intergovernmental Panel on Climate Change, and it has 3 work streams and working groups. And the first working group is about science, and we work together with them to produce a joint paper, which the short title is Summary for Actuaries. It summarizes their findings and observations in their 6th assessment report. And Sharanjit will be talking about that. We are talking about, in our task force, 2 other papers. Their production has started already. The 7th paper will be about Social Security, and the last paper will be an internal paper, so all the other papers are externally oriented to the external world. The last one will be an internal, and we will be reviewing several IA papers already produced if there is any gap in terms of climate-related risks. And also we are discussing a summary of actuary type paper with IPCC Working Group 2. Working Group 2 is about vulnerability and adaptation. So this is connected to our 6th paper, which Barbara will be talking about. So these are the members of the CRTF. It's balanced. There are experts from various regions, but don't forget, there are just like 8 people here about. We've worked together with some others who, in the meantime, stopped working for us. Perhaps the most important one was Fred Rowley, who supported the task force, but he decided to withdraw after a while. But you have to appreciate that there are about 30 to 40 people behind these papers. So the 6 + 1, 7 papers were produced by a whole bunch of experts and papers and volunteers. And I would like to express my deep appreciation for their commitment to these papers. From this podium, I'm thanking them very much. So by that, I will give the floor to Rade, who will be talking about paper 1, the importance of climate-related risks for actuaries. So, Rade.
Thank you, and it's a pleasure to speak to you today. And I'm very proud of the work that the CRTF has done, and also the paper series that we have put together. This has all been work done by volunteers, and as the IAA moves forward, we certainly, very much not only value our volunteers, but they're a really important part of the organization, and hopefully you'll see some of the hard work everybody's been doing here. So I'm going to talk about paper 1, which is a bit of the introductory paper. And I think the first thing that we should note, and there's actually one more paper than we mentioned, which is the glossary. And a very important part of learning about climate is learning the language and understanding the terminology, the acronyms, and everything else. And if you wanted to invest 20 or 30 minutes and get a lot out of the time, it would be good to just read through the glossaries, both in the IAA papers and also the one that was attached to the Working Group Working Group 1 paper, which Sharanjit will produce later. Our author team included people from Canada, the UK, Australia, and Ireland. The group worked very hard to produce the paper, and I'm going to cover it now. The key points in paper 1 were really that actuaries have long played a role in managing uncertainty, and that actuaries are uniquely qualified and positioned to be an important part of the solution to climate challenges, and we have quite a bit to offer the human race in terms of our ability to measure risk, help manage risk, and understand how climate-related risks affect not only financial institutions but all the other places actuaries work. This paper, kind of examines types of climate-related risk and their importance to actuaries, and it concludes with some comments about, implications and next steps. We looked at the top global risks that were reported in a survey from the World Economic Forum, and this is in 2020, and both in terms of likelihood and impact, climate-related issues were near the top, and that's clearly something that has only become more front of mind for people in this area as we've gone forward. So why should actuaries be involved with climate risk? Well, we have a lot of ways that we can add value. First of all, we can certainly understand how climate risk affects models. We can help align product design of insurance products for things like electric vehicles, etc. We can help investors understand climate-related risk and help to measure and quantify that risk in investment portfolios, which then leads to better informed investment strategies and products. We certainly can improve governance, and a lot of us work with boards and senior management on risk management frameworks and governance. And importantly, we can also contribute to the public debate. As I mentioned on Monday, we can certainly inform things like building code development and a whole range of public policy issues that are bound up with climate risk. And certainly disclosure of climate risk is becoming very important with the TCFD and other regulatory requirements. And certainly insurance supervisors have noted the role actuaries can play and have worked with us closely on involving actuaries in supervisory regulatory development. If you think about actuarial modeling, virtually everything that we do in modeling is impacted potentially by climate. And this is a chart from the paper, and you can see if we just look at things like investment assumptions, you certainly have the impact of risks on investments. You've got issues with surrounding stranded assets or changes in investment returns. If you look at the life insurance world and health insurance, where you look at mortality and morbidity, you've got issues around food security, temperature, heat stress, et cetera, and pandemics potentially that could be affected by climate risk. And certainly in general insurance, which is where most people think immediately due to the cyclones, floods, bushfires, and other perils that we deal with, there's clearly a huge effect on extreme weather, as has been shown by the Actuaries Climate Index and other work. But there's more areas of actuarial involvement than just modeling. We certainly can help with product management, product innovation, investments, disclosure, and risk and capital management. So there's a number of areas where the profession can be involved, and the paper talks about those ways as a introduction to actuaries to this space. I know this is a bit hard to read, but there are many examples. We put some in the paper about how do we incorporate climate risk in our work, and we can do that by categorizing the degree of risk in enterprise risk management frameworks, for example. Or we could talk about how each part of the governance framework in a company is affected by climate risk considerations. Your risk management policy, your risk tolerance statement, your risk appetite statements. And we can also inform things like scenario analysis that is necessary to understand the potential effects of climate risk, transition, litigation, et cetera, on firms and their policyholders, their members, their employees, and customers. Actuaries have a great deal of opportunity to participate in climate risk. Actuarial associations such as the Institute and the IAA support research, training, educational, professional development, and engage with regulators. As individual actuaries, you can help by being informed, by learning about climate-related risks, learning the language, as I mentioned with reading the glossaries. Build more expertise, collecting data, starting dialogues with others in your firms and your professional associations. We can also help validate the sources of information that are used in many of the applications for climate, and develop a plan to make climate an integral part of daily actuarial work. And most importantly, again, as I mentioned Monday, continuous learning, continuous investment in reading, learning, and professional development is critical. With that, I'll close, and I'll turn it over to Evelyn to cover papers 2 and 3. Thank you.
So you must have met Rade at the opening day, so he also presented on the opening day. The next speaker is Evelyn Yong. Evelyn is an actuary with 7 years' experience in the life insurance industry, with roles in valuations, pricing, and capital management. As a consultant at Finity's Perils and Climate Risk Practice, Evelyn works in translating climate change projections into financial impacts for insurers and banks. So Evelyn, the floor is yours on our paper 2 and 3, climate scenarios.
Hi. So I'm really privileged to come and stand here and tell you a little bit about paper 2 and paper 3. Like Rade mentioned before, it's a collaboration piece across many authors, and I'm just really lucky to be one of them here to speak to you about it. So paper 2 is an introduction to climate-related scenarios. And wait, how do I do this? Let me try this. Okay. And these are the authors of paper 2. So Musulin, Lubna, Gibbs, and Philip, and from different countries who offered their time and volunteering efforts to write this paper. But why is this important as paper 2? As Rade was talking about, actuaries play a very important role in helping understand and managing risks. And we've been doing that for a very long time as a profession. Scenario analysis is one way to help do that, to help quantify the uncertainties in the future and sort of bring it back to the present and inform people and inform decision makers as to what we can do. So one of the key points of, many key points of paper 2, which I'll not run all of you through, but is that it is a tool that you can use to access your financial impacts of climate change on your firm, on your employer, for your customers, and etc. And one of the main sources of information is from the IPCC, who have published many climate scenarios for us to refer to and to translate that into financial impacts for companies. So one of the things is that the analysis needs to cover a wide range of impacts and a wide range of assumptions to look at. It also needs to account for the fact that risk or climate risk are not linearly correlated with each other. They are quite complex, as I will tell you a little bit more. And we do need to work, I think it's the theme of this conference. You guys have listened to it many times. We have to work in multidisciplinary teams, not just actuaries, because we don't know everything. We are good at certain things, but other people are also good at other things, and we need to work together. So just a brief overview of climate scenarios. I just want to emphasize the point that it is not a prediction, it is a projection of what could happen. We simply don't know what will happen in the future, but we can use these climate scenarios to help inform what could happen if certain emission pathways were to occur. So for example, on the graph there, that's from IPCC 5th assessment report. It shows the range of emission scenario pathways, going from the lowest emissions, which is RCP 2.6, all the way up to RCP 8.5, which is commonly known as the high emission scenario. It's not intended to be a full representation of the future. It's not possible to do that unless, I don't know, you have a crystal ball in front of you, but it represents key elements of what could happen under these certain scenarios. And as you can see, and you hear a lot all the time, that climate change, and it's very complex. It's not just on its own. It's not something that we can just look at on its own. It interacts with many domains of the world. So there's the social domain, the environment, nature, economics, laws, regulations, and it doesn't just stop there, and it's also impacting it the other way around. So while climate change impacts these domains, the domains and what happens over there also impacts climate change. So it's very complicated, but it doesn't stop us from doing anything. It just means that we need to work amongst a lot of professionals around the world to understand this impact. The other important thing that the paper talks about is its iterative process. So scenario analysis is not something you do now, today. You show maybe your CEO, these are the impacts that's going to happen, and you forget about it. That's not how it works. And as actuaries, we are actually quite accustomed to doing scenario analysis, and climate risk is not a very, I wouldn't say it's a special risk out there you have to look at with a different lens. It's pretty much using the same principles we do as actuaries. We look at the bunch of assumptions, we put that into the model, and we figure out what the financial impacts are, and we come up with risk matrices to measure these impacts. And it's an iterative process because what you learn from the process will inform what you do in the next round of scenario analysis. And climate risk is not anything different. It's the same way you treat it, and the same way you look at it, the same way you measure it, and one big control cycle. So like I said, IPCC is a very good resource for climate scenarios to start with, and there's a huge amount of resources out there these days that you can refer to. Generally, as actuaries, we don't need to come up with our own scenarios from scratch. We have a lot of literature to refer to, and you probably just need to start thinking about what sort of depth you want to go into or how wide you want to look at, sort of like a macro versus a micro lens. And if all fails, just step back and think, what if? What if this happens, or what if that happens, and what the financial impacts are, and use those insights to draft action. So that's the summary of paper 2, which is an introduction to climate scenarios. Paper 3 now talks about how do we apply that, that's taking what we learn and applying it. Just to acknowledge the 5 authors again, so we've got Rade over here, Eric, Sam, myself, and Tracy. 5 of us, we worked on this. And what we really tried to do was, the brief was given to us, it was, imagine if you were going to advise your firm in a insurance setting or other financial institutions. How do we start and how do we go about this? We've got all these climate scenarios, we've got all this literature out there. How do we start? So the key points of paper 3, it's, like I said, we were gonna go on this journey and figure out, all right, how are we gonna do this? We're gonna look at physical risk separately. We're gonna look at physical risk and use CMSI as an example of how we apply physical risk scenarios in Australia. So CMSI stands for Climate Measurement Standards Initiative, and it was developed using it's developed and adopted for local areas such as Australia in this case. We also will talk about how we could look at transition risk, how do we even start, and what other literatures we could look at. Systems thinking is something that I think is repeated a lot as well in this conference. It's thinking about the interconnectiveness of the risks and not just physical risk or transition risk separately, and not just the built domain separately, but rather across all domains. The paper actually has 3 case studies to take you through each one. I won't go through all the case studies today, but I'll highlight a couple of them with you. So on the first one, CMSI, Climate Measurement Standards Initiative, that's one example where we used, we can be adapted for local areas such as Australia. In this case, it considered 2 emission scenarios, so the low emission scenario, which is RCP 2.6, and the high emission scenario, RCP 8.5. And it considers it under different timeframes at 2030, 2050, and 2090. And it not just looks at the extreme weather events, so the acute risk, it also looks at the chronic physical risk, which is, includes sea level rise or temperature change, which could lead to other risks. And the goal of this was a framework, actually, to provide something standard for people to use so that when you do a comparison between firms, it's something easy. So if someone says, this is the projection we used under the low emission scenario versus the high emission scenario, it is comparable. Transition risk, we sort of thought about how we could do it. So if you were in a company, you were trying to figure out what transition risk could do to your company. You could start by identifying the different potential actions that people would take around your company, so your industry, governments, shareholders. But you also need to also think about the time frame at which they will take these actions. And you need to consider the national policies and translate all of these goals into specific actions. And one of the important things is to identify the risk and opportunities coming out of this. So, for example, how is it going to impact changes in your supply chain if you're in the motor industry? Or how is heat stress, for example, going to impact your mobility risks? So it's a very top-down way of looking at it, looking at how things are changing over time as well. And it's quite a long horizon if you think about transition risk. Systems thinking, without explaining too much about it, it's, again, trying to get that interconnectiveness. So you take a step back, you zoom out. Everything you were thinking about before was, oh, how is that going to impact your company? Or how is that going to impact your products or your customers? And now you take a step back and think, how is it going to interact with everything else in the system? This is quite difficult to do. You would need to work with a lot of, but it doesn't need to be only non-actuaries, but normally experts from different fields will be able to give you different points of views, and will be able to challenge your views, and you can challenge their views. And in the end, it's a discussion that leads to making sure you cover interconnectedness and not just silo thinking in just one area. The other thing you want to consider as well is, like I said, the correlation between different risks. And one thing I want to call out on this slide is the risk of groupthink. I was just having a conversation with someone else before during lunch, and it's not a word that's foreign or anything. It's a risk that, as a profession, as we work together, it could tend to be one voice after a while. You want to prevent that. You want to involve as many non-actuaries as possible, as many people with different viewpoints to avoid groupthink, so that you can get different points of views. And I like that quote up there because the whole point of scenario analysis, again, coming back to it, is you know that physical and transition risks will happen over time. We just don't know when, and we don't know a specific location, and we don't know the timing. There is one case study that I want to highlight from the paper, just quickly. So two of them, actually. And this actually demonstrates the sort of interconnectedness we have in the world today. One example is the extreme weather event that happened in 2010 that led to a wheat crop failures, and which eventually then lead to food price security problems. And it affected countries over in the Middle East, it affected North Africa, and it placed a really big strain on their social systems. Another example you can see on the slide here is a flooding that happened in Thailand in 2010, which impacted global supply chain for automobile parts. It wasn't something that the manufacturers were prepared for. They were caught off guard, and production was impacted across the economy and the whole world. So it just goes to show that something happening in one part of the world can impact the whole world. And that's how, I guess, interconnected our world is today. And with that, I will end my section on papers 2 and 3 and hand it over back to Gabor. Yeah.
So the next speaker is Dale Hall. Dale is the Managing Director of Research for the Society of Actuaries Research Institute. In his role, Dale is responsible for managing research projects and experience studies across the SOA's wide variety of actuarial practice areas, markets, and coordination strategic research partnerships. He's a frequent speaker at the insurance retirement industry meetings to highlight the SOA research, including research presentations to the National Association of Insurance Commissioners and Congressional Committee testimony on pension plan mortality rates. So, Dale, you will be talking about paper 4 on asset portfolios. The floor is yours. And by the way, please ask questions. These will be answered after all speakers have spoken. So I encourage you to ask questions. Thank you.
No, thank you, Gabor. Good to be here, and very proud to highlight what I think is a really important paper in this series. I may be a little biased and say this is, maybe one of the most important papers in this series, but if you know me, I have an investment sort of background, worked as an investment actuary, did a lot of merger and acquisition and asset adequacy analysis in my career before coming to the SOA. So really just another place I'm proud to see where the actual profession is making a difference when it comes to applying climate risks in these scenarios to evaluating asset portfolios. It was great to be part of a team that we'll highlight here at the end that worked on this. Overarching, I think that, again, this really drives some future opportunity for the worldwide actuarial profession. Applying our actuarial skill sets by the use of these types of scenario analysis is a really important way to do our work and looks at the impact of assets from a climate risk perspective. There's probably a little bit of ways to think of this as asset liability management or portfolio immunization at times. Probably also a really good way in the paper that you'll see, there's an application of some bottom-up approaches to just selecting assets, recognizing the different climate risks that are out there. But once a portfolio is constructed as well, there's a macroeconomic kind of top-down approach that I think is spurred and thought through in the paper to look at how a portfolio might react under different asset scenarios. So, what is this importance of climate risk assessment for assets? Back to just even basic asset evaluation, where you're looking at the present value of cash flows to get what an asset's price is or what an estimate of price is given supply and demand. We would start to say, just look at what those cash flows are expected to be. Are there any risk associated with those cash flows? And historically, it just kind of limits many of those risks to what are the financial risks. Would a bond issuer default on a coupon or have trouble making a principal repayment? Well, that would be certainly incorporated into the price, or even the timing of those assets. What are the call risks that might affect the timing of different cash flows from an asset? But I think this climate risk assessment takes that to another level as well, an opportunity to think about what are different scenarios that are out there. Investment managers and especially actuaries considering what are physical risks that could happen in the near term that would impact a bondholder, a bond issuer's ability to pay back coupons and principal, or if you're an equity investor, how would strategies of the corporation that you're investing in be impacted by near-term physical risks to the environment or that they may face. So I think a really important part from that perspective. There certainly is an opportunity here for us to think about this from an investor preference approach as well. I mean, the world of climate risk awareness is ever growing. I think we see that in the news cycle, and we see that as we talk to our cohort of actuaries and partners across the actuarial profession. There's a growing trend on how people are thinking about environmental, social, and governance policies and what the impact that's kind of shaping investor preferences as time is going on. You see publicly traded companies thinking more about ESG initiatives. You see even examples of shareholders influencing, as key shareholders in a corporation, what corporate policies may be. So I think we're only at the cusp of the importance of what these climate risk assessments for assets might be. The regulatory guidance for sure is increasing as well. I mean, I think that's a great thing that the actuarial profession brings to an understanding how the business and regulatory financial supervisory worlds all come together. Clearly, you've heard some mention already about the Financial Stability Board, this task force that they created on climate risk financial disclosures, or TCFD, becoming a more common acronym. The Prudential Regulatory Authority now asking companies to kind of name a chief climate risk officer. They want to be able to pick up the phone and talk to someone who knows what's going on there. The International Energy Agency is referenced in the paper, this desire to get to net zero, the roadmap by 2050. And even in many local markets in the US and all around the world, you have local market stock exchanges, securities commissions, financial supervisors all focusing on this, and probably seeing the biggest impact, especially in the life insurance and pension world, where there's huge pre-funding of future liabilities that are happening. The asset portfolios get to be really big. Those institutional investors are a key part of what goes on in any economy. Maybe even challenging in some markets, banks and securities exchanges, and probably even bigger than what central banks are in many of these markets. So an important role for actuaries to think about in that climate risk assessment for assets. Pension fund fiduciaries, as noted here, and insurers and other financial institutions are certainly responding. They're thinking about this more, even locally in Australia. Plan participants are encouraging their pension fiduciaries, their fund fiduciaries to think about what does it mean to incorporate climate risk analysis so that we have a long-term stable portfolio that can fund the payments that will be made to pensioners for 30, 40, 50 or more years in the future. And I think really the paper notes as well how to leverage the actuarial skill set on scenario analysis. Evelyn did a good job of highlighting what some of those are. More and more we see that the scenario analysis is a key skill of actuaries, and to be able to assess the types of risks that may play out over dozens, hundreds, tens of thousands of different scenarios. We're accustomed to doing that for equity returns, for interest rates, for catastrophic modeling, laying out a wide variety of events that could occur, seeing what the impact of those events on the assets and liabilities of the companies that we work for and how they play out. Scenario assessments, increasingly, again, beyond just equity and interest rate scenarios. You saw some of the examples from Evelyn, and the paper goes a little bit deeper into say, here's a great way to think about different things that could play out and different scenarios that are highlighted. Representative concentration pathways from the IPCC are definitely highlighted in the paper. We currently you saw in Evelyn's chart there, I think we'd estimate that we're probably around RCP 3 today. That means 3 watts per square meter. But as time goes out, we'd want to be able to say, all right, what happens if we get to RCP 2.6 or 4.5, or hopefully, not 8.5. That could be a catastrophic scenario. But, what is the impact of those scenarios as they play out on the asset portfolios that actuaries are helping manage, and assessing against the liabilities is really important. The IEA, this International Energy Agency, also thinks about it, as you saw in one of the graphs in Evelyn's work, on gigatons of carbon dioxide, or I think the acronym or the abbreviation was GTCO2. And the goal, obviously, is maybe to get to net zero at some point in time. It may take a while to get there, but what is the path that we're going to follow? I think most people would assess we're probably, instead of net zero, we're at net 31 or 32 or something like that today. There's a lot of paths that we can follow if the goal is to eventually get to net zero, and using those types of scenario analysis and to understand what it means for any individual asset, but what it means for the macroeconomic impact of any economy is really important, highlighted in the paper. And then, as noted at the bottom of the screen, there's impacts on how does a market's GDP play out as they go down any certain scenario or pathway? What happens to interest rates? What happens to inflation? This whole transition over time is a really important part of what happens there. The final things that are in the paper are really looking at things by asset class. Of course, a lot of variety here, fixed income, as we mentioned, cash flows, equity investing, thinking about the ways that corporations, have an awareness. Is it an energy stock? Is it an airline stock? What are the transitions that are going to happen? Real estate, I think, is important. We're here in Sydney, where it looks like there's been a lot of resilience put in on the waterfront, but maybe not so when it comes to cities like Miami, New York, other places around the world. And then looking at different green asset classes, what are the different renewable energy investments, that may be made. It's kind of a small but rapidly growing market. I think, there's a lot of education and awareness that we see actuarial organizations doing, and you want to make sure that greenwashing, this concept of not just, pasting over and saying that you're sustainable without a lot of objective data behind it, that's a really important concept, and the actuarial profession is really good at creating and turning objective data into a way to say, yes, that is a company that has a sustainable idea in their corporation. Finally, there's a little bit in the paper, too, about how it impacts different places where actuaries typically work. General insurers, maybe shorter duration assets, a little bit more heavy on equity, and potentially also exposed to some operational risks when catastrophes occurred. Life insurers and pension funds, I think, again, are the big opportunities there, looking at long-term modeling of scenarios. Also, will there be changing capital requirements or enticements to invest more in different types of green assets versus brown assets in the future? Would financial supervisors, look to consider that? Lending banks also have this combination of some physical risk exposure, mortgages or properties that are financed assets that are part of the equation. And then some good case studies. I would point out there's a nice IFOA paper that looks at a UK-defined benefit pension fund that walks through a couple different scenarios, and also some product opportunities. What are some product offerings that life insurance companies, for example, may be looking at, and an important way to look, too, at the asset portfolio of life companies that way. And just to give credit, I give credit to this group. Andre Choquet was a great lead on this paper. Musulin de Yong also gave us really good advice as to how to structure this within the context of the previous papers that had been produced. So a lot of good reaction and a lot of good interaction between this group to create a strong asset-related paper. So with that, Gabor, I will turn it back to you and go on to the next one.
Thank you indeed. So the next speaker is Darren Fleming. Darren is a fellow of the Institute and Faculty of Actuaries in the UK and a fellow of the New Zealand Society of Actuaries. He has 25 years experience in various roles in pensions and life insurance in both New Zealand and the UK. Over the last 10 years, Darren has worked within the life insurance industry in New Zealand, initially as a valuation actuary within a life insurance company, and more recently as a consultant assisting a broad range of New Zealand companies with understanding their reporting and capital requirements. Darren is a convener of the New Zealand Society of Actuaries Sustainability Interest Group and has a keen interest in environmental issues, both personally and professionally. So he will be talking about paper 5, or paper 5, on disclosures and risk management. So Darren, the floor is yours.
Thanks, Gabor. So yes, I was lucky enough to be asked by Rade to be author on paper 5, climate-related disclosures and risk management standards and leading practice. So this is our author team, and I guess big thanks to Jerome Crignola from Switzerland as our lead. He managed to pull us all together and did a hell of a lot of organisation and admin behind the scenes, so great job by him, and then also our other co-authors, Santiago, Amanda, Cynthia, and me. So the main points from our paper, I suppose, are that climate disclosures are sort of aiming to provide transparency between the impact that climate change might have on a company or a financial institution, but also to recognise the impact that the company's activities will have on the climate. So sort of both sides of that direction there. And what we were seeing is a lot of different local and international standards and initiatives being put out there, and perhaps some of them are starting to converge, for example, around the TCFD, which we'll come to in a minute. But there's quite a lot of material, and we sort of managed to pull together summaries of quite a bit of it. And also, climate disclosures requiring reporting information from climate-related risk management, and we looked at how that might fit into an organisation's sort of wider enterprise risk management structure. So a brief outline of our paper. There's sort of 6 main sections to our paper, which are laid out there, and we'll go into those in a wee bit of detail in a minute, plus also the glossary that Rade mentioned. This bit of update was made alongside our paper. So the first section in our paper was on the Task Force on Climate-Related Financial Disclosures. So if you're not too familiar with climate-related disclosures, hopefully you've at least heard of the TCFD. That's getting quite a lot of publicity. The TCFD was formed by the Financial Stability Board in about 2015 and reported back in its recommendations paper in 2017. So they came back with 11 recommendations for disclosures under the 4 pillars of governance, strategy, risk management, and metrics and targets. Since then, they've been publishing annual updates, and there's also a reasonable amount of guidance put out there by the task force, both in different areas in those pillars, but also for different types of organisations, so within the financial sector, but also outside. And I'd note that the TCFD has formed the basis for a lot of standards worldwide that are getting produced. We also looked at other initiatives that are out there, so for example, the UN Principles for Sustainable Insurance, and also our paper was written in sort of early 2022, following on from Glasgow COP26, where there was a lot of talk about net zero alliances and bringing them together under the Glasgow Financial Alliance. I guess it's kind of topical recently in that a number of large insurers have sort of pulled out of the Net Zero Insurance Alliance for various reasons, but stating that they're also keen to continue following the UN Sustainable Insurance Principles. Noting also at COP26, the International Sustainability Standards Board was launched. So there's a little bit in our paper about that. And then we've talked a bit about climate and sustainability disclosures for financial products. So this is setting out some standards for how to categorize different products. If you're claiming that your product is sustainable, does it actually fulfill the requirements of a list of criteria in order to prevent greenwashing, essentially? And then also there's a section on the Task Force for Nature-Related Financial Disclosures, which looks at biodiversity and habitat loss as well, sort of a bit step further than just climate change. Turning now to taxonomies on sustainable activities. So again, this is a classification tool for categorizing investments and activities as to what's green and what's not so green, just to set some standardized categorization, just to, again, to fight greenwashing. And the taxonomies fall into two main categories. So green taxonomies, which are seeking to identify positive climate action, and then brown taxonomies, which are the opposite, looking at activities which might be negative towards climate. And again, there's a lot of different regions, countries, private sector, NGOs who are releasing these taxonomies, so there's quite a range of them. And perhaps the most well-known one is the EU Taxonomy on Sustainable Activities, which was released in 2020 and is currently undergoing a review. But I think over time there's probably a need to harmonise those and come up with some standardisation across the world so that there's consistency between jurisdictions. And then as mentioned earlier, there's a section on integrating climate risk into the company's ERM framework. So just considering how those climate risks are brought down into the risks of the business, whether they're separated out into the risks that the business already has or whether they're dealt with separately, what sort of governance might need to go on around them, controls, the responsibilities of different people within the organisation, just to make sure that climate risks are being considered appropriately. And then there's a bit of talk about how to monitor the exposure across different parts of your business, so the investments, your underwriting or lending if you're a bank, and then sort of the company's own activities. We touch on climate-related scenarios and also regulatory stress tests, which there are a number have happened around the world, and some of them are coming sort of into the second iteration of stress test. And then again, looking at the role of actuaries and how we can help in that space. Finally, there's a bit of a summary of different regulations in different jurisdictions around the world. And then we pulled out some examples of climate-related disclosures from different sort of institutions, so global reinsurers, large insurers, financial services, and pension funds. And what we were trying to do is pick out some of the best practice so that people would be aware of what to look for and perhaps get some ideas of how they could generate good climate disclosures as well. And I guess this perhaps isn't a situation where we've got winners and losers. We either all win or we all lose. So if we can all put together some really good disclosures, then maybe we get a better understanding of the risks that are in the industry and the financial services sector. So lastly, just some links to our paper there, and also there was a presentation late last year, and there's a link to that and a video on the website, so I'd encourage you all to go and have a look. Thank you.
So our next speaker is Barbara Damroji-Ola. Barbara has a PhD in mathematics from the University of Helsinki. She's a fully qualified actuary. Since moving from the academic world to the private sector in 2003, Barbara held progressively more challenging roles in the Ilmarinen Mutual Pension Company, where she is now working as chief actuary and manager of the Actuarial and Analytics Service Department. Barbara is active in different committees in the IAA and also the task forces, and she was the chair of the Social Security Committee between 2015 and 2020. So Barbara, the floor is yours. By the way, keep asking questions. I received a couple of ones, but keep asking them.
Thank you. So it's a pleasure for me to present to you this paper that is related to the adaptation gap, but especially an actuarial perspective. So here is the drafting group, and as you can see, I'm no one of them, but here is a pool of really professionists, and they are all over around the world. And this is really important for this kind of paper because climate change is affecting different countries in different ways, and they are reacting in different ways. So we have a really great vision of what is happening. So what is this paper about? You know that adverse outcomes of climate change have been seen everywhere, and we know that they are getting worse. We know also that there are quite many mitigation actions, but sometimes it seems that they are not working so well because the consequences of the climate change is just accelerating. What do we need? We need to build a resilience. And so it also means that if we invest on climate change adaptation, then the cost of the climate change ultimately will be lower. For this reason, this paper tells us how actuaries can help in diminishing the in speeding up the adaptation and diminishing the gap between what is needed at this time and what we have achieved. Here for you is an outline of the paper, and I will go little by little deeper in this paper. So I think that the authors did a great work. They used models that are really known to us actually, and they adapted to the climate change risk. First, in this slide, you see that there is a difference between adaptation and mitigation, and this is pictured using the 3 lines of defense model for risk management. This is something that actuaries know really well. And so what happened there, mitigation is the first line of defense. So it means that we reduce the gas emission and we collect some of the gas out of the atmosphere. But then the adaptation, it's the point in which we do something to combat the climate change effects. And for example, actuaries can do it by strengthening the building of codes and making, for example, codes for building houses that have doors that can contain the excess of rain or something like this. So they sound really simple solutions, but we don't have them yet. And the third line, it's the last but not the least. It means that really we should have some solution when unfortunately we have losses due to climate change consequences. And for example, we have to have insurance that diminishing the cost for the people. We have to have public and charitable assistance, but we also have to have a process to learn from what has happened. If we go to the overview of this paper, we have something that we have to learn about. One is resilience. So it's the capacity to cope with these events. Then we have to develop an adaptive capacity so that we can somehow adjust to the damages. And then we have also be able to recognize maladaptation. So it means that we can do something to adapt and to get adaptation speeded up, and then we get some consequences and somewhere else is going bad. So we have to learn how to recognize. The same is for cascading and compounding risk. So it can be that risk separately causes less damages than them altogether. And the more difficult thing is to learn how to make adaptation plans. So if we think how we can learn and how we can develop this skill, so we need to build codes. And we have to take care of future condition and future uncertainty when we build them. So we are building them not only for the present, but especially for the future. So this is something where actuaries are really good too. We also have to have some health action plans. It means that, for example, we have to build better climate-friendly urban design and zones. We have to develop a way to reduce the damages to the agriculture. We know that, for example, we need seeds that are resistant to the drought time. We also have to have some responses to sea level rise, and why not to the diminishing of the water. In the paper, there are 2 case studies, one from Barbados and one from India. I warmly recommend that you give a look to them. They're really interesting. We also have to have some supply chain management strategies. So when the water is low, big boat, ships, they cannot go. And the solution at this time is to put more smaller ships and boats. And this is not climate change friendly, of course. And we also have to manage relocation. Since in the last 20 years, approximately 4.4 million of people has been relocated. So what the actuaries can do and how can they help? So we need to have some cost benefits analysis and scenario testing. And we have to think again about the role of insurance. Some of the insurance products should improve the developing of should improve the resilience and speed up the adaptation, maybe by pricing or by finding out new products. We should improve education and communication. We have a lot of skill. We should use them to influence policyholders and stakeholders. I already spoke about premium pricing, underwriting, new products. We can do a lot of good things. But maybe the best we can do is to improve and encourage the investment in adoption, and so somehow to insurance the capital and to steer them away from exposure. And keep our ear open and take care that we are a bit all over working with other stakeholders. Here we have another really friendly, actuary-friendly model. So it's an adaptation risk management process. And it's just something that we know really well. We first find out which is the risk. We collect all the information, we make the model, and we get the results. One thing I would like to stress in this slide is the monitoring. The climate change risk is changing really fast, so we cannot rely that the data we have now will help us 10 years from now. So the monitoring and the predicting of the change is really important. These are the case studies I spoke about before, and few further consideration and then conclusion. So we have to take care of the time horizon. I mention it in the model, but we have to make consideration on the short and long-term perspectives. We have also to take care about vulnerable populations, and especially about migration, because there will be part in the world where it will be not possible to live anymore. We also have to coordinate actions. So we have to take care that if we do good on one side of the world, this does not cause any bad on the other side. And this is really linked to the role of government and supervisor. When I speak about coordinated action, I also mean that both insurance field and regulator has to work together so that the actions go in the same way. And of course, the role of disclosure is always important. And we have to point it out for all the standard setter and investors. So what are the conclusions from this paper? So we need to transform the system proactively so that we can build resilience and reduce the exposure. There is a really big need of extensive risk data and information from around the world. And we need a comprehensive risk management process that will help us to reduce the damages and the losses. We have also to develop loss models and scenarios, and we have to communicate. These are all actuarial skills. This means that the actuaries can really contribute to the design of solutions that will help to reduce the climate-related losses and damages. And we can also help in designing incentives for the private sector so that we can implement solutions with the use of insurance pricing. So just let's start to work.
Thank you. So the next speaker and he will be speaking about our joint paper with the IPCC's Sharanjit Paddam. Sharanjit has nearly 30 years experience in actuarial consulting in the UK and Australia. He has received numerous awards for his work on climate change, including Insurance Leader of the Year by ANZIIF, Risk Manager of the Year by the Climate Alliance, and Actuaries Institute's Distinguished Service Award. Prior to working at Finity, he was Group Head of Environmental, Social, and Governance Risk at QBE Insurance Group. He co-leads Infinity's climate practice and advises insurance banks, investors, and governments on climate risk assessment, management strategy, and reporting. In 2022, he authored a green paper for the Actuaries Institute on home insurance affordability and socioeconomic equity in changing climate, and gave a TEDx Sydney talk on climate change, banks, and insurers. So Sharanjit, the floor is yours.
So hello, everyone. Pleasure to be with you here today. I'm going to talk about this paper that the IAA did in conjunction with the IPCC. It really speaks to me about how we collaborate with the climate scientists. I often speak about our work in climate change as actuaries. For me, it's very much about the interpretation and application of the science. And so a really large part of this is working with the scientists to understand what they're saying and how that, what the implications are for that. So the paper, there we go, was a joint project. It was led by the CRTF of IAA, but also the IPCC's Working Group 1 scientists. So Working Group 1 was one of 3 working groups in the IPCC. The Working Group 1 produced the physical science and what's happening around that. So the idea was for us to summarize what is relevant in the Working Group 1's report to actuaries. The report itself is thousands and thousands of pages, so we figured, so part of this work was a science communication effort to work out what's relevant to actuaries and to pull that out. The lead authors were Musulin Dion, Gabor Hanak here, and Rade Musulin. I was a contributing author together with Steve Bowen, Eric Dalmoro, Alex Pui, and Yudanka Velchikova. So I always have a moment when I read slides like this, which is, this is what scientists have been telling us for 20, 30 years. And, every 5 years they tell us again, and they did that again with AR6. But, here we go. Climate changes are happening. It's real. It's been caused by humans. It's some of the changes we can't go back on. But we can actually make a difference today by reducing emissions. We have to do that rapidly, and we have to do that at a large scale. Otherwise, we will have temperatures rising above 2 degrees C. And lastly, I guess the extra bit here is that actuaries as risk professionals need to understand these things so that we can help influence and drive decision-making around it. But there, just in case you hadn't heard anything about climate change, those are the key messages that came out of this report. Okay, some more useful things. Well, one of the things that this paper also brings out, which I think is really relevant to us as actuaries, is how we work with uncertainty. The IPCC reports are really good at this. They talk about every statement in their reports has an associated confidence and an associated likelihood level. So there is large amounts of uncertainty about what exactly climate change will mean. There's also a lot of certainty about what a climate change will mean. And the report is very good about separating those and talking about these different pieces. I'll come a bit more down to this in a later slide, give you more a concrete example about this. But it is a very good way, and I think actually we can learn a lot as actuaries about how people communicate the uncertainty. So extreme events. Here are two things that actuaries have already contributed. The chart at the bottom is the Northern American Actuaries Climate Index, and the one at the top is the Australian version. And both indices are tracking extreme weather over time. And it's very clear from this trend, in case anyone was still uncertain about this, that climate is getting worse. Extreme weather events are becoming more frequent and more severe over time, and this is not projections, this is actual data from both sets of charts. What the AR6 report and the working group report this time around was really good at was it focused on extreme events. And extreme events are very important, I think, from an actuarial perspective, because these are what drive damage. These are what drive. So it's not necessarily a couple of degrees of higher temperature. It's not necessarily a little bit more windy today than it was yesterday. It's the extreme events that break thresholds and cause damage to the environment, damage to people's health and lives. And so AR6 report, the working group report this time around, it very much brings out the extreme event picture, whereas historically it was much more focused on global mean average changes, for example. The report then talks about how these will change in the future projections. That slide's too small for me to go through in detail with you, but it breaks down impacts on heat, impacts on agriculture, and impacts on floods, both in terms of frequency and severity, and under future climate scenarios of different temperature rises. And it's worth spending time looking at that one, not before you go to bed, because the nightmares aren't great, trust me, but definitely in the cold light of day. The other thing that AR6 report compared to the previous reports was very good at doing was sort of differentiating on different regional effects. One of the lessons that keeps coming back to me working in climate change area is that it is not a universal one parameter change thing. It has differential impacts in different regions for different groups and different domains. And part of the complexity and understanding that we have to grapple with is how that all fits together. And the AR6 report was very good at this, because it has underlying it these kind of hexagons that make up the world map, and it shows the different impacts in different regions. And it helps us understand what the picture looks like and where these impacts are going to be. From an actuarial perspective, the timeline considerations are very important. I think lots of the previous presenters have talked about this, so I won't go into it in too much detail, but I will say it does depend very much on the industries we work in. Property insurance is very short tail, and we're looking at impacts in the short term, but as we move into thinking about product design and longer products, we have a longer horizon. Banking and lending often is up to 30 years. They have a much longer horizon. And social security systems and governments also need to think about a longer time frame. This is complicated because there's also natural variability within the climate, driven by internal variability, so things like El Niños and La Niñas, but also external natural variability due to things like volcanic eruptions. And on top of that, we add on the anthropogenic component, which is driving the longer-term changes that we're seeing in longer-term horizons. So the report, as I mentioned, did focus on extreme events, but it also does talk about the sort of chronic changes over time, which is more gradual background changes that will also drive the acute events, but will also have implications on their own right, particularly for things like agriculture, particularly for things like where people can live, what are the habitable niches of the planet, and talks about the importance of mitigation. One picture here as well is that there is a real lag between mitigation and impacts on the actual climate. So you can see, for example, in the top chart there, that between the different climate scenarios considered in AR6 in the report, there's actually not much difference until we get to around 2050, and then we start to see divergence. So what that says is that actually it takes time for emissions to work their way through to temperature changes, to sea level rises, to impacts on floods, and those pieces. And so one message is that it doesn't matter what we do over the next 20 years. Hopefully you don't take that message away and you take away the other message, which is we have to act in advance because there is a delay between our action and the impacts on the planet and on extreme events. I'll skip the next bits and come and talk to you about this one. So this, again, is something that's in the report, which you'll see a number of these tables. We've pulled out the one for Australia here. But the report is very useful for thinking through the actuarial work and thinking about impact. So you can see here that it's broken up Australia into different sections and New Zealand as well. So there's 5 in this corner of the globe. It talks about the impact of climate change in a number of areas: temperature, precipitation, wind, and I can't read the others from here, so I won't give it a go. But you can see like a number of drivers of climate. And underneath, it breaks out what the impacts are on each of those areas and gives us that spatial resolution that I think is critical to the type of analyses that we think about in climate change. But also associated with each one, there are colors that indicate the certainty or the confidence, that we have in each of those kinds of predictions. And so this is a highly useful tool to use in constructing your scenario analyses and thinking about all the other pieces that my previous colleagues and speakers have talked about. I would say have a look at the report, or at least look at the actuarial summary that the joint working group produced. One interesting thing I'll draw your attention to is the interactive atlas. AR6 has been great at making the information accessible and usable. The interactive atlas is a really great piece on that. So that's a kind of whistle-stop tour through this, and I will hand back to Gabor, I think, at this point. Thank you.
Thank you. Thank you very much. So just before the questions, I would like to speak a little bit about our international activities. So we've been dealing with these stakeholders. Most importantly, I think one of the most important stakeholders for the IAA is the International Association of Insurance Supervisors and the Sustainable Insurance Forum. Those are key stakeholders for us, and we've been talking with them. Also, some United Nations organizations, most importantly the IPCC, so the Intergovernmental Panel on Climate Change. So these are our main stakeholders in the of the task force. But I would like to mention also that one of our stakeholders is the IA leadership as well. So we've been advising the IA leadership, and we managed to secure that the leadership approved a climate action plan. That action plan includes several items. One of them is related to our paper 5 on disclosures. So the International Sustainability Standard Board issued two draft standards, and the IA decided to work out a statement of intent for a model standard, actual practice standard, ICEP. It's going to be ICEP 8. So there's a mandate to the Actual Standards Committee to work out a statement of intent and submit it to the Council of the IAA. At the same time, there will be a supportive international actual note developed by another committee, and all these developments will be consulted with our member associations, so each of you will have a chance to make an impact on what the IA is going to do if you participate in the consultation. So there will be a consultation process for both the ICEP model standard or the statement of intent for the model standard and the international actual note. I would like to perhaps note finally that there was an important endeavor by the IAA to delegate 2 people personally to COP27. One of them is Rade Musulin. You have heard that already, I guess. He mentioned that on the opening day. So it was an important meeting for us, and we met some of our key stakeholders personally there, the ISSB and the Working Group 2 of the IPCC, and it allowed us to see the presentations on new technologies, adaptation, mitigation, and so on. And we learned that there is much more going on than what's included in the government agreements and what makes the headlines in the news. So by that, I would like to conclude, and I would open the question part. You have already submitted a number of questions, so I would start with the question about the likelihood of scenarios. So the question is about how would we go about quantifying or maybe using a qualitative assessment of the scenarios which play an important role in various decisions, including investment decisions and valuation or capital assessment. So how are we going to go with assessing the probability, estimating the probability of each scenario? Anyone who would like to answer, please indicate. And so Rade first.
Yeah, I might start because our paper 3 actually addressed some of this, which Evelyn and I worked on. I mean, it's important to remember a couple things. First, you need more than one scenario. So you need a range of scenarios that can paint a picture of the future, and often you have to assign probabilities to those scenarios or understand how they interact with one another in order to form a full view of the future. The other thing, too, is that scenarios should not be created and forgotten about. Evelyn mentioned that, too. So you need specific, what I call mileposts, or maybe kilometer posts here, but certain points at which you can say, okay, well, if we're going to achieve net zero by 2050, perhaps we need to have electric charging stations for electric vehicles by 2030, and we need to have this by 2035, et cetera. And then you need to develop metrics with each of those things and test how you're traveling along the path on each scenario. So it's much more than just saying, oh, we're going to hit net zero in 2050 and not worrying about it for 30 years.
Anyone else who would like to?
Actually,
So Evelyn and then
I was going to
Sharanjit.
say, maybe one, I mean, that's a good question because I feel like when people ask me what do I do in work today, one of the questions doesn't really, the question is asking what's the probability of each scenario, and I don't think there's a value in putting or assigning a probability to any scenario, is the short answer. It is more to explore what could happen, and like Rade was saying, it's constantly changing, so there's no point setting a scenario up and not looking at it for the next 3 or 1 year or 2 years. You really have to keep going back and asking for feedback around the room, outside your industry, inside your industry, and constantly look at that.
Sharanjit, you would like to?
yeah, look, I guess I have a much shorter summary about that, which is the whole point about scenario analysis is you don't know the probabilities, right? That is the whole point of it. It's a tool to explore the uncertainty and the consequences and the impacts of that uncertainty. It is not a tool to give you a single price or a single number at the end of it. Yeah.
Thank you. There's a specific question to Dale. In Australia, superannuation funds have to make investment decisions based on members' best financial interests, meaning that if a green investment is paying a return lower than a brown one, then the brown one will likely be invested in even if the brown investment has more climate risks attached. In your experience, how is climate risk being accounted for in expected returns of projects, and if not, how do you think they should be, and should government get involved via regulation in making sure companies are taking this into account?
Yeah, I think that's that concept of short-term, long-term is the big debate that's out there, and I think that's where a lot of financial markets and exchange commissions and stuff like that have said, no, we really want to encourage, call it ESG investing or call it awareness of long-term impact of what corporations are doing, and so. I think that there's a growing focus more towards show how investments that you're making are long-term societally beneficial rather than just what is going to be the cash flow in the next quarterly earnings statement. And that seems to be what a lot of financial supervisors are encouraging or thinking about in creating those types of regulations. It's early days on all of that for sure. But that seems to be the path that's going on. I think the key thing is just making sure that the most important part of TCFD and that acronym is the financial impact part of it. I think we do this focuses a lot on climate risk. We focus a lot on disclosure, but the actuarial profession's opportunity is then translating what could happen in these scenarios that we're talking about it into financial impact. The Financial Stability Board, probably never had a task force on interest rate disclosures, but if they did, you can picture, what that type of output would be. We want to know what the financial impact is of interest rates changing. Well, I think that same philosophy, starting to come through is not just recognizing that there are climate risks, recognizing what the type of investment philosophies might be, but what are the financial outcomes from those scenarios.
A quick comment too, that one of the things we have to do is improve our metrics because there's a lot of cost which is currently not being reflected in so-called brown investments. So you may get a return from an investment in an oil company, but you're not taking into account at the moment all the damage that may be doing to the environment. And when that gets corrected, I think the green versus brown debate will solve itself.
But it needs some time and discussions, I guess. You want to?
Yeah, if I could just
please go ahead.
to add to that. So I like the answer that the CEO of CBUS, one of our largest superannuation pension funds in Australia, gave, which he says, yes, we have to think about members' financial interests, but one thing we have to think about is, what are they retiring into? Are they retiring into a world where we have natural disasters all over the place? Are we retiring into a world where there is, social disruption and social upheaval going on around them, but they're fine because they got a lot of money. He says, and pretty much what Rade is saying is that as a superannuation fund, particularly a mutual customer-owned one, we have to think about the retirements of our members in a more holistic way. And I think that's when you have the right metrics, when you're thinking about it, it doesn't matter if that person has a lot of money, if they, can't leave their house because there's floods everywhere. That when you start to look at a broader dimension, that is actually a problem that disappears.
Thank you. Another question is, it's an important question whether green transition and a sustainable economy can thrive simultaneously with continuous economic growth, which is exponential. Have you thought what a negative answer would mean to social security systems and other elements of modern societies built now on the assumption of continuous GDP growth? Yeah, Sharanjit?
Yeah, so I always hear this, and then I look at, what will we require to achieve transition? We look at how much investment is needed. We look at how much technology is needed. We look at how much upskilling of people is needed. We look at how much of, agricultural innovation we're going to need. And people keep telling me that that's GDP negative. I don't believe it, actually. I think that action on climate is actually positive GDP growth. Any simple understanding of the problem or economic analysis will show you that the opportunities from climate, and particularly in the rapid injection of technology that we're seeing, will pay dividends in terms of economic growth. And I think that's a really important role that we can play as actuaries, to understand how that systemic impact will actually enable us to pay for the transition we need, but also to secure a prosperous future for everyone.
Anyone else? No? Then let's go. One more question, perhaps. Still have some time. Risk-based premiums need to be increased in flood-prone areas, often populated by less well-off people. How do you balance giving price signals, guiding societies to more sustainable construction, with the need not to exacerbate social inequalities?
Yeah,
I thought it was.
I could start on that. I think that again, I was alluding to that a little bit Monday in terms of the, fact that we have to not only come up with the correct answers on risk-based pricing, but we have to figure out how to implement them in a way which is socially responsible and respects communities and people's, livelihoods in their homes and their retirement savings that are in those homes. So I think this is a social challenge which actuaries can add a lot of value to try to balance, risk pricing with responsible treatment of people who are in risky areas, and trying to design a good cost-benefit framework to figure out how much we can invest in resilience to reduce the risk so insurance gets affordable to everybody, and we can all afford risk-based premiums.
Good. Barbara?
Yeah, especially in this case, I think that it's really important to take into account different culture and different part of the world, because the effects and the actions has to be really different. So we need a great collaboration around the world.
Thank you. Yeah, we have one more minute, perhaps. One more last question. Someone asks about insurers or big groups abandoning net zero. You have any thought on that? I'm not sure if they really abandon, but they exit the alliance. But Sharanjit, please comment.
Yeah, look, I think it doesn't make any difference. I think it doesn't really change anything. The drivers for actions for insurers are very much their investors, are their stakeholders, are governments, are their customers. People leaving the Net Zero Insurance Alliance actually is just going to make it harder for them to take coordinated action. But I don't think any of them are going to stop. I think there's a lot of room for collaboration, and that's what that was the strength of the NZIA. That hasn't changed, and insurers will carry on collaborating in these issues. The NZIA is not the only forum where insurers are thinking about the common issues and tackling them. Dare I say, the IAA members and the actuaries are also having an influence in discussion. The risk professions are all involved, and they're all collaborating on this. I think this is much more about a political signaling game.
Okay.
And, okay, that may suffer a setback, but I don't think this will make a real change.
Okay, thank you. So, lastly, I would like to thank the IA for creating this task force, the members of the task force, the members of the drafting teams. They have done an enormous job, very successful in my assessment. Thank you all for participating in this discussion. And you can find all papers on the IA website. There's a slip of paper which you can pick up at the IA booth or here. I will put it here, where you can easily connect to the part of the IA website where you can find these papers. And thank you for all those who actually commented our papers and who will be commenting our next two papers in the future. Thank you very much for your participation, and then don't forget to come back at 4 o'clock for the closing session. Thank you very much.